Hello and welcome back to another Macro Mondays. We have plenty of topics to cover today, and starting off with the upcoming rate cut that we have in the coming week from the US Fed. Basically, a lot of people have been expecting a 25 basis point cut, whereas investors over the last couple of days have been increasing the probabilities of a 50 basis point cut, which has kind of oscillated over the last couple of weeks. What we would say is that we're expecting, or the market at the moment is expecting 25 basis points with a higher probability of 50 basis points starting to emerge. If there was a 50 basis point cut at this point, it would be relatively surprising considering of some of the sticky nature of inflation in the last CPI report, and things from a commentary and narrative perspective seem to be relatively stable. There's a lot of commentary around the consumer remaining strong, labor market remaining relatively strong, and the economy in general holding in there. So if there was a 50 basis point cut at this point, it'd be relatively surprising and potentially could be a negative for equities because participants may interpret that as the Fed panicking. Another interesting and very relevant change over the last week has been that the yield curve has finally uninverted, which is not a great sign and another recessionary signal, which could be getting even steeper and further un-invert like we've seen in the past. So we've been seeing this and kind of observing it and watching it for well over a year now. And now that the un-inversion started, we would expect that it could lead to a recession. Larry Ellison jumping on the recent AI hype cycle, or I mean, it's been a relatively sustained hype cycle, but now he's jumping in and talking in the media, and the company that he runs and owns 45% of, Oracle, has been touting their enterprise AI solutions and talking a lot about generative AI. Also making comments in this video image here about the race of AI and how him and Elon Musk were begging to buy GPUs from NVIDIA. And also talking quite a lot about the energy requirements to run these data centers. Seems a little bit bubbly here. From some of the conversations I've had with people that are well across the AI and energy space, they don't seem to be as alarmist as some of the CEOs of the hyperscalers around the energy requirements for AI. I guess there's a part of me that thinks there's a little bit of a creating a crisis to, I guess, demonstrate or justify the demand and the investments being made, kind of over touting the energy requirements when we don't even really know how we're going to scale and apply some of these AI solutions. So definitely interesting to watch, but potentially just CEOs trying to pump up the current thing. Another interesting piece of information that's happened over the last week would be that there's been some rumbles in the banking industry around delinquencies specifically due to unemployment. So we've recently had the cost of crisis conversation and narrative in markets and discussed in the banking industry around some of the strain on consumers and some of their clients. Now we're starting to hear rumblings around unemployment and how that's contributing to delinquencies. This Ally Financial, who made the statements around this, I think it was their CFO in their earnings report, that those comments led to JP Morgan dropping 5% in a day, and many other bank stocks starting to see a little bit of weakness in their stock prices after having a really strong run, especially as this interest rates on treasuries have been dropping. So this bond rally has really kind of helped financials. And then I guess there's a counter trend now where you've got potentially some issues and strain in the banking industry again, or in the banking sector, that may flare up. You know, we think about lowering interest rates. We think, oh, well, that's great. That means that banks are going to be able to lend at lower interest rates. It doesn't necessarily lead to more lending, at least immediately. So I would say that The banking industry is a relatively complex one and not insulated from further kind of tail risk events. Nonetheless, we'll be watching it carefully. I think delinquencies are a really important thing to watch around cars, also credit cards, and then, yes, mortgages too. And actually, this kind of goes hand in hand with the financials play and the bond rally and the banking industry. So you'll notice from this chart, the blue line is gold. So gold has spiked up over the last year, going up well over 30%, and over the last couple of days spiking up as these rumbles in the banking industry have started to creep into the media. And I don't think that's necessarily a coincidence. I think that gold rallying like this doesn't make me confident, makes me kind of concerned to why gold is spiking. And it's a little bit of a funny coincidence given that all of a sudden the banking industry is having some rumbles and potentially some talks of some distress in certain loan books. But this chart actually kind of talks more to how utilities, and I've used the XLU ETF to demonstrate this, but utilities have been on an absolute tear recently, and also TLT has, and gold. So gold's also spiked up. It's been relatively volatile at times, but in the last couple of days really spiked up, but been on a pretty strong run for the last year. Utilities, which should be typically considered defensive, could be a rotation into something defensive like utilities for a recession kind of play. Maybe investors are starting to allocate capital there for that reason. And also this hype around AI and how the energy sector will be impacted by the need for all of this energy could also be contributing to the ETF's positive price moves. And then you've got the TLT, which is a long-term treasury, also going on a nice run as rates have dropped sharply. These things would often make you believe that potentially the equity market could be going down, but we know that the equity market has bounced back once again. It's almost at all-time highs, at least from the S&P 500 perspective. So the bond market is potentially front-running the Fed, and it often front-runs the Fed, of course. The bond market is in real time, and then the Fed is often behind the curve. So I love this chart. I found it on Twitter. You can see where there have been rate cuts and how 50 basis point rate cuts are not a great sign for equity markets. You'll observe here that potentially with the bond market kind of forcing rates down here, the Fed is going to follow suit and potentially have to cut rates really fast. So that goes to show that the bond market is kind of ahead of the game, and then the Fed is going to eventually play catch up. If we do go into a recession and there are lots of rate cuts here, the equity market would be considered exposed for sure. But I think this slide here is really just kind of emphasizing the fact that the Fed's going to have to catch up and going to have to cut rates pretty soon and potentially quite aggressively. The problem with a 50 basis point cut is it looks like they're out of control. 25 basis point cut is what's considered in the playbook right now and would demonstrate or signal the fact that they're not behind the curve, at least from a initial market perspective. And actually, this kind of goes hand in hand with the financials play and the bond rally and the banking industry. So you'll notice from this chart, the blue line is gold. So gold has spiked up over the last year, going up well over 30%. Another piece of the global kind of components that we need to look out for and is kind of providing some warning signals as well, unfortunately, and that would be that China is very close to deflation right now. They've got some of their lowest inflation readings since the pandemic, and that also goes for their interest rates on their bonds have been absolutely crashing, which means their bonds have been rallying really hard. That is not great, and it's not looking like a positive sign for China. And also their equity markets have been also selling off dramatically despite having a strong year until recently. So kind of China's off to the side. There's some weird economic activity going on in the country around the banking industry and their bond market, and the government basically trying to control their bond market, which is not going well right now. But yeah, not great. Not a great sign if China's not doing well. It does reverberate through the global economy, and it is a anecdotal piece of evidence that perhaps there is a larger slowdown at play here. So now we have current multiples. We've been looking at the multiples. I saw a different chart recently where it had the NASDAQ 100 and the MAG 7, and those multiples are also historically high. So when you look at asset prices in general, when you look at an index level especially, you go, well, assets are on a relative basis trading at a premium. And I guess given the seemingly robust nature of the US economy and how resilient it has seemed to be, potentially due to some really savvy interventions through government and fiscal stimulus and the treasury markets, have basically managed to keep the US market in pretty good stead. You would say, okay, well, maybe the US should trade at a premium, but at a 21.24 forward PE, that's really high. That's well above the 30-year average. So you kind of get a little bit nervous here when the valuations, the multiples themselves of the S&P is close to the 2021 bubble and not too far off from the .com bubble. So I guess the TLDR right now is that there's lots of kind of activity going on in currency markets, bond markets, economies around the world, and different recessionary indicators are all going off, while equities seem to be trading, at least in the US, at a hefty premium. Do what you will with that information. The market is in a very fluid place right now and a super exciting place. So we look forward to see how the rate cut turns out this week and how markets ultimately digest that information. And we get to find out if it's a 25 basis point or a 50 basis point move. So we'll be reporting on that next week. And we look forward to seeing you on the next episode. As always, none of this information is personal financial advice. We don't give any buy, hold, or sell recommendations of any kind, or recommend buying or disposing of any security or asset. This is for information and educational purposes only, and we look forward to seeing you on the next episode. Thanks and goodbye.